Well, as you know, that has been consistently one of our favorite trade. First of all, for being an idiosyncratic trade that allows us to diversify away from some of the other more global risks that we've been sort of facing in other markets. I think the main thematic there, however, has been the markets in Asia that we've been most interested in have been those that are more at the forefront of pricing in policy rate expectations. And China was the first to do that last year. Following up from that, you'd have markets like India and Korea, where we've all seen opportunities to take some risk in the bond market, given the pricing in of policy rate risk. Of course, now we get the additional benefit that some of the concerns the market has is some degree of softening in the growth momentum in the China market, and of course the fallout from this elevated volatility coming from a number of risks emanating from China, which is causing obviously bonds to rally. So at the moment you're generating very, very strong performance, and for any investors, whether you're running Asian bond books or EM bond books, or particularly global bond books, where global bonds have still sort of struggled a little bit year to date, this has been a very good trade to have on in your portfolio. And we still see room for continued performance in the months ahead before we maybe start to look to take a bit of profit on that trade.
Sure, but do you prefer short-term EM bonds or long-term EM bonds?
We've generally obviously been having a little bit of a short duration bias. I mean, inflation has been somewhat elevated in the region in particular. And generally, if you look at the outlook, while it may be a bit more medium term, we still have this reflationary risk where, you know, outside of these short-term inflationary pressures, which will likely dissipate as growth recovers, you'll start to see inflation next year starting to gain a bit of traction. So we still obviously have a short duration bias. The other thing that is useful is that yield curves are generally quite steep. And so, you know, the optimal point on a number of yield curves tend to be around the 5-year, where you see the optimal steepness, which means you've got good carry and roll down in that particular tenor. And it should give you a bit of a buffer from volatility on the curve moving forward.